All right, well, I guess we'll get started now. Welcome, everybody, to the Decoding Banker Strategies, Insights into Restructuring and Workout Solutions. My name is James Timko. I'm an attorney with Dean Mead in their Orlando office. Dean Mead is a mid-sized law firm with offices across the state of Florida. Our main office is in Orlando, and I cover cases across the state and bankruptcies nationally. I will be moderating this panel, which is intended to give more of an insider's look at how banks deal with distressed debt situations. Hopefully, it'll be helpful with borrower negotiations to have a better idea of what maybe the bank's thinking, assist attorneys who represent banks in considering what their clients may be thinking, and also just to kind of assist parties in approaching bank negotiations. Let's start with introductions. Jason Alpert, we'll start with you. Jason Alpert is the managing partner of Castle Bar Holdings. Jason, why don't you tell us a little bit about yourself and Castle Bar?
Good afternoon, everybody, and thank you for joining today. My name is Jason Alpert. As James said, I work for managing partner for Castle Bar Holdings. We're a distressed debt investor as well as a bank advisory company consultant that helps banks with their workout solutions and tries to find solutions to some of their asset problems. I've been in workout almost 15, 16 years since the last recession. Most recently managing the workout group for the state of Florida for Wells Fargo, as well as leading our portfolio sale process for the bank.
Thank you, Jason. Michael Logan, managing partner of TML Corporate Strategies. Why don't you tell us a little bit about yourself and TML?
All right, thanks, and good afternoon, everyone. Career distress guy, probably been in the space something like 40 years now. Early on as a turnaround consultant, then running workout groups for probably 32, 33 years for a couple of different institutions. Took early retirement, and about 7 or 8, going on 8 years now, formed an LLC to provide advisory services on restructurings, not really on the operational side. It's more on the deal aspect of getting deals across the finish line. And other than a retainer with one sort of large direct middle market lender, pretty much everything that I've done on the advisory side has been on the company side. Also serve as an independent director on boards, served on both public and non-public ones, both in and outside of bankruptcy.
And Bill Kruger, Senior Vice President, Truist Asset Resolution Group. Why don't you tell us a little bit about yourself and Truist?
Sure, thank you. Appreciate everyone joining today. I've been with SunTrust since 1995, got into the workout world in 2000 with the first downturn then, having known various people on that side, and have spent the last, I think, 24 years in the corporate workout world, handling everything from equity sponsor cash flow deals to oil and gas deals to real estate deals, helping the bank work its way through those challenging situations. Right now, I got 24 years in the workout world and have seen a lot of things, but every day you learn something new.
Absolutely.
So we do have a set agenda today, but we were actually hoping to get some questions from the people watching. So I have the chat open. So if anybody has any questions or thoughts that they want to share, please type them in, and I'll try to incorporate them the best that I can. It's rare that you have an open channel to 3 people with so much experience in this arena, so who are actually going to be answering the questions and may not necessarily be adverse at that time. So please ask questions, and I'll do the best to incorporate them. But let's start with you, Bill. So we're talking more about the commercial real estate and C&I type loans. What factors does the bank start to consider, or what red flags get raised when special assets may start getting involved with a loan or credit?
Sure, I think that's a two-pronged approach. The first is sometimes sector-driven or industry-driven. If a certain sector's seeing a lot of stress in it, we'll start reviewing that portfolio in its entirety to find the most challenging deals within there. And the second's on an individual company basis. Individual company basis is usually when we have some kind of covenant breach, or it's underperforming, or it hasn't underperformed yet, but we're getting some kind of aggressive amendment attempt. And the folks on the sales side of the line of business side will reach out to us to just consult with them to get our thoughts. We try to maintain an excellent relationship with them. It's much easier to get involved earlier and kind of act behind the scenes before there's a problem, so that we don't enter into amendments or other things with the borrower that create a more challenging situation if the conditions that brought it to our attention continue to occur.
So when you say sector, so like, for example, right now, casual dining, I've noticed has a lot of stress. So is it typical for a lender to start looking at not only whether or not they have any loans with, the restaurants themselves, or maybe landlords that are exposed to?
Yes, it's exactly. If you know that a specific market, I'll go back 8 years when the oil and gas market went sideways. I think I had myself and another person had most of the oil and gas portfolio to work through all the balance sheet restructurings. In this particular case, commercial real estate's challenging, so I think we have a much earlier look at stuff than just we get to a point of a covenant default. It's really trying to get ahead of the curve and make intelligent decisions before you're forced into a situation where you've got a client who wants to hand you the keys.
Yeah, I mean, the bank, in my experience, there would be, just call it from the last couple of years, office has been, on top of everyone's mind as an asset class that's in distress. And then there was actually, horizontal reviews across lines of business where, our independent, risk asset review team would go in and we want to look at all these offices. If it doesn't matter if it's wealth, if it's middle market, if it's commercial real estate, if you have an office as collateral, we want to make sure that, what this credit's doing, how up to date it is, are the risk ratings appropriate and accurate. And so that could be kind of like from a high level 30,000 foot view. But then it's like from an actual like servicing standpoint, it's just having the bankers be aware of, when they talk to their customer, what could be some early warning signs that they need to be looking out for. Did the customer just tell us, that they're going through a divorce? That's probably something that we should empathize with, but, maybe start talking to them about how that's gonna, affect that if it's a small business. Do we get financial statements, and when do we get them? Does it show declining trends? Are they not communicating with us? All these type of things should be, raising red flags with management. And then, as depending on the situation, a really healthy organization will have, a shadow or like Bill says, a consult that you can pick up the phone and, hey, we're seeing this. What do you think? And you kind of talk through it.
So when you say a shadow, so say I'm a borrower and I get a call with my relationship person, or I get a letter, or email saying, hey, I noticed that you have a Red Lobster in your shopping center. Is there a special assets officer that's already potentially shadowing that relationship or paying attention to that relationship? When exactly does special assets maybe get involved?
It depends. I mean, it could be as early as, wait, we just got a notice that Red Lobster filed and we have 3 different loans that have collateral as Red Lobsters. So let's look at each one with a little bit more of a finer, microscope, and bring in, workout to advise if there's any issues that we need to kind of work through. And it's directed by the line more so than workout, how much engagement they want. So in my experience, they'll say, yeah, we need you here. Or can you just look at the fine points of this term sheet that we're giving out, and here are the basic high level facts, and what do you think? It just depends on the asset. But typically, if it is a criticize, if it's moving towards a criticized asset where we're going to downgrade from, performing to a watch list, workout should be involved and be prepared. And if it's, 6 months or so and workout shadowing it, but there's no resolution, it's probably just needs to be sent to your workout, in my opinion.
What is the,
Yeah.
oh, I'm sorry, Mike.
I was just going to say, I'm sort of dating myself because, like I said, it's probably been 7 or 8 years since I've been on the inside of the bank. But traditionally, what I always used to see, and I know talking with some other banks, that it's still more something along the lines of, they'll go with what the regulatory ratings are going to be. If there's a special mention credit, it generally is not going to come into the workout group, but it might be something that you would start to shadow, and shadow can mean a couple of different things. It could be that you're going to basically just sort of be there in the background to work with the relationship manager. Or I've actually seen deals where in order for the relationship manager to sign off on something, they need to get the sign off of the workout group person as well. But sort of the hard line when things automatically came was when something became substandard in the regulators' parlance. And most banks, I guess, have still got the rating systems all over the board. 1 to 20, 1 to 10 mean all sorts of different things, but that's generally what I've been used to.
So what is there any significance, say a borrower's meeting their payments and all those things, is there any significance to being moved to the watch list at that point, or can they be moved to the watch list at that point? What is the significance?
I don't think so. I mean, my experience again, what has been or used to be was that, I mean, even a past credit could actually get moved into the workout group. It happened a lot during the, say, 2008, 2009 period with a lot of large national home builders. We saw what was going on in the landscape, and the credit wasn't necessarily something that was having performance issues at that point in time, but they just became exits for the bank. And so as a result, and they were exits for the bank because something simply was out of footprint for us. It was a one-off sort of a situation. And in those instances, you would move it to the workout group. So, I mean, we've had deals where the loan's still performing, and a regulator, whether it was the comptroller or FDIC or whoever, would come in and put the thing on non-accrual. So there's really no rhyme or reason to perform it sometimes, which is seems sort of odd, but that is what I've seen.
Yeah, I would kind of, expand on that a little bit more. Like my definition, and the way I kind of would explain it is that anytime that there is going to be, an identified risk and it cannot be readily mitigated by the line, or it's going to take a period of time where it's taking too much of their opportunity cost to service it and to monitor it and follow up with what needs to go on for it to get back to mitigate the risk or resolve it. That should probably be something that's sent to, monitored by a workout group, that has the time and experience to get through whatever the risks or multiple layers of risk that kind of compound to help manage through that process. I mean, but yeah, there's times where, the payments are being made as agreed, but there's going to be a giant covenant default when we get those financials because of what they told us or what, we saw in the news or whatever. And it's like, let's send it to workout. And that way we can start building a rapport with the customer, getting, setting expectations. And then once that event happens, we probably have a solution by then. And hopefully we've already kind of cut off, except, the issues. We don't want to, the worst thing you can do is just dump something that's past due, or we have a covenant that we didn't, test or monitor. That's 3 months late. And now, here, go fix it. Like, well, now you're handing me a thing that might be already broken or the cash is already gone. There's no free and clear collateral. You kind of limited my options, but that's why, early prevention, just like anything like in health, preventative maintenance, early prevention is worth its weight in gold, preventing something from being sick.
Yeah, I think what I would add to that is having a good relationship with your workout partners or the workout people having with the line partners is important, because as I tell people, the worst thing that happens is you spend 5 minutes with me and I tell you you're doing everything right. The best thing I do is keep you from making a decision that would put the bank in a worse position, because I'm looking at it from a different perspective. And that's not good or bad towards the line of business. It's just, as workout people, we're able to silo our jobs, and I think when we do that and try to add value to our line partners, most of them, don't view us as three-eyed ogres. We have a long, good relationship with them.
Just stepping back for a second. So let's talk about like just kind of like the internal procedure for a bank. So you have a distressed loan, and say you're developing a workout plan, or maybe an amendment to the loan or forbearance agreement. What is who are the decision makers within the bank that approve such things? I remember when I was a younger lawyer, I'd be working something out, and then it would be like, okay, now we got to go get approval. Who are the magic people that give that approval, and how does that procedure work?
Mike, you want that one? Or I'm happy to take it. I mean,
I could take it too. I mean,
yeah, I mean, it's the workout world. As I tell people, we don't make credit decisions, we make business decisions. Credit decisions easy, we don't want to do it, but the money's already out the door. Secondly, I think it's much easier for workout folks to move forward with unusual structures that fit the situation than the credit folks who originally approved the deal. We constantly, I call it sandlot football. I've invented things that I wind up using over and over again because they work for the situation that aren't in traditional loan documents. So it's a case by case basis, but most borrowers are either upset or kind of shocked to find out they're in the workout world. But over my years of doing this, most of them are actually happy they got sent to the workout world, because it's not paralysis by analysis. We're moving forward to address the process, and can put them in a much better situation, depending on what it is, to continue to move forward and restructure their business or sell their business or have a productive relationship with the bank, even if it's something we're exiting.
One thing I would add is it's very institution specific. A small bank's going to have a much different process and team and what they're going to do than a large regional versus a mega money center bank. Similar to what Bill said, when I was at a major money center bank, when it moved to workout, I had a certain level of credit authority, and my bankers would go and work out their deal. But before they could, issue any type of formal thing, it would have to come to me for credit. And if it was, or for approval of the terms of the deal and the high points. If it was beyond my authority, it would go up to, whoever had the proper, pen. But at smaller banks, it could just still be, the decision might ultimately be with the credit committee, whoever that's comprised of. So there could be multiple people that have to sign off with it. They got to present it, and everyone's got to shake hands and say that's what we're good with. But sometimes that can limit you. If you're in a mediation, you need to get to a deal right then. You can't call your credit committee on standby. You need to get some level of authority, so as you can make a business decision in real time, as long as it's within a certain level of scope.
Yeah. From the company side, I see a lot of different models out there. When you're looking at the alternative lenders, the non-banks, they generally don't have workout groups. So it's the same people that originated the loans that are handling those. And they've got their investment committees that they tend to go through as far as getting sign-offs. But even some of the regional banks and even some of the large banks, probably not the money center banks per se, but I've seen situations where when we're working with whoever it is, and even if it's a workout person, that they still have credit authority or credit approvers that are in the credit administration side of the bank that are ones that they still have to go to and sign off. So it's, I mean, obviously the best one is one that, you know, Bill and Jason have described, and it was one I was familiar with, where, you know, when a deal came into the workout group, I had the full ability to essentially deal with the credit at that point in time. I didn't have to go outside for approval. I could do it myself, but I still see a lot of different models out there, which
And
probably
one
makes it more difficult for the company, truth of the matter.
and one thing I would add is, you know, a healthy relationship with your line of business is one that I'm going to make this decision based on these facts, but I'm also going to let my line of business partners know. And I'm not just making it in a vacuum, you know, or I may even want to get their input, you know, especially if it's a strategic one, like, is this an exit or retain customer? You know, if I go down this path, is this a customer you definitely were going to take back and you're going to want me to nurse back to health? Or, you know, hey, this was a one-off deal that I wanted. We were trying to win the rest of the business and it didn't end up working out. They never moved over to their treasury and blah, 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 blah. Like, that's going to be a whole different approach. So, you know, and that's why when you're having you know, a good kind of practice is having a quarterly kind of discussion or periodic discussion with everybody, talking about the credit and making sure we're all on the same page as this things move forward. So you don't
Yeah,
Yeah,
surprise.
that's what I refer to as the speak now or ever hold your peace internal meeting.
Yeah.
So,
You know,
so
yeah,
Jim,
no, I would say that's a good point, because everything that obviously comes into a workout group is not a workout, it's not an exit. I used to make the statement that while, you know, my group could have a huge impact on the bank's bottom line, we didn't pay the bills. So a lot of things that we did, obviously, are going to impact the bank in the marketplace, and as a result, we were always trying to be cognizant of that. But clearly, I mean, I actually coined a phrase for some of the credits, as we would call them work throughs. We were just trying to work through it and find a way to get it back to the line at some point in time.
so
Yeah. I
I-
would, oh, sorry, Jim. I was just going to add, like, it takes a lot to originate a deal and it costs a lot of money. It takes a lot of time, you know, all that effort that goes into bringing in a deal. It's not cheap and it's not easy. So I always kind of approached it, unless the line said this is a hard exit, they lied to us, you know, they did this A, B, and C, we just need them out, like, kind of deal. You always want to approach it from the standpoint of, like, all right, can we fix this? Is this a problem that can be solved? Can we restructure it somehow and get it back to the line of business? Especially if it's a one-time, you know, they blew a debt service coverage because of some issue that was outside of their scope, but it's going to take them a while for management to understand and get through it. Or is it, you know, again, it's an industry we don't like anymore, or it's one that we're not comfortable with, and it's the geography we're not used to, and let's just make the decision and work, you know, work through it as under our loan documents and keeping our reputation in mind, and not making, you know, having a foot fault where we create a lender liability issue.
So there's actually a lot to unpack there. So from the borrower's perspective, on the front end of the loan, are there advantages to the borrower to, you know, I think borrowers don't realize that banks make a lot of money on deposits. They make a lot of money running their accounts through the bank and those things. So is there an advantage, a potential advantages to borrowers to moving all of their business over to a bank if it ends up in a workout situation versus doing a one-off loan? You know, are those things that are taken into account as you're trying to work out a loan that might be in distress?
I think what Mike said is the appropriate, is being someone in the workout world. We look at it from, you know, relationships with the bank has with the client, the reputational risk of the bank, and the risk in the marketplace. That being said, you know, you never want to put yourself in a situation where you're catching the proverbial falling knife to try to save something. So you have to have that internal, you know, speak now or forever hold your peace, so we can all make a decision and live by it, and move forward institutionally. I think the challenging situations come about for clients is when they're getting mixed messaging. They don't
Yeah,
they don't know which way is they don't know which way is up with the institution. One guy's on the sales side's desperate to save the business because he thinks there's some transaction coming down the road, and on the other side, you got the workout people going, we're getting out of the sector.
Yeah, I mean, from a standpoint of like a customer has a full blown relationship, with the bank where, they have these loans that are, whatever. But they also have all their treasury services for the operating entity. The guarantor has their wealth relationship. I mean, we used to have to keep that kind of in mind. But you balance that with what's going on with the deal. And if it's like, look, this deal is we can look at 100% loss on this deal, and it's going to be multi-million dollars. If that's not worth the deposit and treasury and wealth services, then we're going to need to make the best decision to not lose millions of dollars. But if it's kind of like a 50-50 call, or we can maybe do this structure, give them the benefit of the doubt. I mean, it's always helpful to have liquidity in the bank that you can maybe look at and monitor. I mean, that was always helpful from my standpoint. Sometimes you get into a little bit of a cross purposes if that somebody in wealth has the wealth relationship for a limited guarantor, and they don't understand why you're taking this action, and you try and explain to them what's going on. And there's been times I told the wealth group, like, well, you guys have the full investment portfolio, go ahead and do a margin loan and take us out of this bad real estate deal if it's that much to you. I mean, and they don't want to do, sometimes they don't want to do that, and then it's fine, we'll let you make your your decision. So my line of business partners cost center shouldn't be subsidizing your profit center because they're taking losses on this asset. We should figure out a way how it benefits everybody.
That is the perfect example of the speak now or forever hold your peace. You let everybody know what's going on, and they either say it's that valuable and okay, or they toe the company line. And that's really the most important thing when you're dealing with these complicated relationships.
But to Bill's point earlier, that when it transfers to workout, there's only one person, and you make this very clear in the introduction when you meet with them, and your introduction email and your introduction letter. I am the only point of contact for you and the bank. So they don't go, I mean, sure, they're going to do what they want. They're going to go around your head. They're going to send the letters to the president and do whatever they need, do whatever they think they can to get what they want. But, all formal communications coming through me or my designee, who I will let you know. So, and you tell your salespeople, like, if they call you, you kick them to me. If they email you, you forward it on to me. Like, you can't have mutual discussions, because that will get you in big trouble in a legal sense.
So when we were getting ready for this webinar, we discussed accounting briefly. And, you see in the papers that there's, banks are accounting for loans differently, and they have different requirements and different regulations and those types of things. Can you, provide just a brief explanation as to how internal accounting relates to distressed loans and how that might affect workouts?
I think the easiest way to describe it is, my job is to get the best risk-adjusted net present value recovery for the bank, and given its desired outcome, whether that's to maintain the relationship or exit. And when I say risk-adjusted, I mean by execution strategy. It's real easy to liquidate a company, but you're going to get the worst recovery. And it's real easy to believe in a management plan, but it's really hard to execute given they've gotten themselves in the situation they're in. So it's just, that's the art of this process when you're in workout. It's, what do you guys want to do with the company? Okay, now that you've given me directions, here's what I can do.
What advice would any of you give to a borrower that finds themselves in a distressed situation as far as trying to get the best outcome for themselves?
Mike, you've seen more of these than both of us combined.
Yeah, so first thing I would say is that, well, you've got to have the conversations and you go through all the stages of denial with them, which is going to be, the denial, anger, blame. You recognize those things. And a lot of times the first sort of issue that you have with the company is that they want to argue as to whether there's a problem or not. And the way that I would sort of shoot that down and at least get them to understand is that, and this was primarily because I was dealing with syndicated credits, I would say is that, okay, even if I were to absolutely agree with you relative to, what you've just described, is that if one or more of your lenders thinks you got a problem and you're in a covenant default situation or you've got a maturity coming up, then unfortunately you've got a problem and you got to deal with that. And, beyond that, it's going to be the situations where you're saying you're going to be forthright. I know a lot of people believe that it's sort of a hide the ball. And that's going to be one of the things that's going to really hurt your credibility as far as dealing with a lender at that point in time. And so you can't sit there and do that. You've got, the communication is going to be important. It's going to be one of these situations where you are going to be, confronted with situations which you're uncomfortable with, that you haven't been involved with. And it's really just sort of taking the approach that you need to sort of, to some extent, follow, what you're hearing. It's not to say that you have to agree with everything right out of the box, but those are going to be some of the initial sort of the things. I'll let some of the other guys weigh in, and I'll come back with some more stuff in just a second. I'll give them a chance.
Yeah, I would say, my thing I always told, the borrowers that came into my shop or that my bankers had, and when I trained them up to always ask is, be open and transparent. The more information that you give me, the more I can explain what's going on, and, trust but verify for sure. But if you're telling me, here are my financials, here's my personal financial statement, here are all the tax returns, I put together this budget, and this is what we are forecasting. And, yes, I'll credibly challenge some of the assumptions if we're doing our job correctly and ask appropriate questions. But at the end of the day, if it's a deal that's just toast, or, look, the borrower, is not able, they had an industry, go back to your Red Lobster example. They have a tenant that filed bankruptcy and they're gonna not lease that space anymore. It's something we have to work through. Here's the termination. Here's the court filing. Here's what they plan on doing. Here's who they've hired to help manage through this process. I can go sell that. All right, now it makes sense. All right, let's give you 6 months to release the space. We're going to reserve our rights and remedies. We're going to do a forbearance agreement, whatever it's going to be, and give you the time. But if you're just saying like, this is a technical default, you can't do, if you start bowing up and I'm not going to give you that because it's not in my loan documents, or, if you're not trying to help me with the solution, I can't do anything to help you. So then it's just, all right, well, I guess here's the default letter, and the rights and remedies under here allow for me to charge default interest. And that's the path we're going to go down until you can come back to the table and give me what I need.
Are there any strategies with respect to forbearances? Are there any strategies other than the full open kimono strategy, I call it, with respect to forbearances that, if a borrower is seeking forbearance, is there things that they can present to better their chances for that?
I think from the bank side, when you get into forbearance and you've got an acknowledged default, the most important thing for us is a waiver of claims and defenses. And I get some clients who don't want to do that, and I look at them and I said, look, I'm giving you a break today. If there's something to fight about it, let's fight about it today. But I'm not going to go through this negotiation and attempt to come up with a consensual resolution, and then you come back and retrade the world 6 months from now, 9 months from now. If you want to fight, let me know what it is and we'll deal with it. But if not, just like it is internally, it's with the client, it's kind of speak now or forever hold your peace. And after that, it's just whatever the bank thinks it needs in the interim to bridge to get to a solution.
Yeah, I mean, every time I talk about workout with banks and I'm talking to their executives and I'm doing my workout 101, always a waiver of claims and defenses is brought up in any transaction that you're going to do, modification, renewal, whatever it is, to at least let's start fresh from this point in time. If you have some claim, let me know how I can fix it. So one, if it's an issue I need to remediate internally with the bank, we can start working on that. Or two, if there was a way that you were impacted, I'd rather work with you now and solve that problem than you coming back and, you know, us fighting about a lender liability claim in the future. Tell me what happened. Tell me what the issues are. Give me the evidence and I'll take it seriously. I mean, I'm not going to, you know, but if you just tell me, well, you know, Billy the banker promised me when this was originated 10 years ago, this deal was supposed to be at 2% interest, fixed for interest only for, you know, for 20 years. Give me the email. Give me the term sheet where that was. If you're just saying that because Billy the banker has left and he hasn't been at this institution for 9 years, like that's not really, you know, kind of an excuse. But if you want more time, this is the cost for it. You know, if you want your 3 months, 6 months, 9 months, whatever, you know, this is what we need.
Yeah, I would say that regardless of whether it's a longer term or it's a short term sort of forbearance, you know, that the things that are still going to be important, you know, is to not for the borrower not to get out over their skis, not to start thinking about and promising things that they can't do, or they don't know whether they can actually do at this point in time, because you don't get that many bites at the apples, and credibility is important. You're also going to need to be able to distinguish between the needs versus the wants. A good example of the deal I was in recently, and you know, it was a deal that was, I believed, and turned out to be the case, one that was eminently financeable. There was more of a sort of a politics issue. Not that there wasn't some hair on the deal, but there was more of a politics issue with the existing lender. And we got to the point where the last issue that was on the table was a $50,000 monthly payment that was being paid to the CEO's dad, who was also the founder. The bank drew a hard line in the sand and said, no, absolute no way that's going to be paid. CEO, on the other hand, drew equally as a hard line in the sand and says, if that's the issue, he said, then we're not doing a deal. Well, it's kind of like you sit down and you talk with, or I sat down and talked with the CEO at that point in time, and I said, first question is, does your dad need the money? He said, no. Okay, I said, you do realize that since your dad doesn't need the money, we're sitting here with a 90 to 120 day window that is going to allow us to get refinanced. You and I both believe that this deal is doable. Your dad doesn't need the money. Why fall on your sword for something like this? When in fact, if you get the deal done, then you're going to be able to go back and then you can re-implement the $50,000 payment to your dad on a monthly basis going forward. However, on the other hand, if we don't do this deal, then you don't have a company and your dad's still not going to get the $50,000. So which of those two scenarios do you think you ought to do? And so, you know, the light bulb goes off. And so that's the real issue that I see a lot of times. And it's also true with the bankers as well, is, you know, trying to argue or determine or differentiate between what a need is versus a want. And everybody wants the wants, but what you really need are the needs. And that's the biggest thing that I think, whether it's consultants that are working with the company or lawyers that are working with the company, can really help them understand is that distinction.
So we've got our first question here from the audience. So in order to try to get more people to ask questions, I have a question from the anonymous attendee. Interesting name. On average, what % of credits that go to workout end up going back to line versus being refinanced?
Well, I'm probably going to defer to the two active people, since Jason was more recently doing it, sort of the answer to that. But I think it really is a function of the size of the credit. I'd say that, you know, certainly the smaller dollar credits, the business banking type credits, not very high. You're going to work up the trend when you get to the middle market situations. It's going to be, one that's going to have a greater chance. It's also going to be a function of how that bank is structured and how proactive they are. If you wait until transferring deals when it's at the 11th hour, you got a crisis on your hands. Your options are a hell of a lot more limited at that point in time. Fixes are a lot tougher. You're not going to have hardly any degree that's going to return back to the line if that's the way the bank is operating. But if you're being proactive and you're involving your workout people on the front end, it's going to be a much higher chance. But since again, hadn't been doing that for 7 or 8 years, but those are just thoughts off the top of my head.
Like I would agree with you. I think it really comes down to when it gets in our hands and what the bank's goal is. Because in most of our cases, while they're typically operational fixes that need to get implemented on the larger side, it's also of an issue of what's the appropriate capital structure, and where does a commercial bank fit within there. And if you're early in the process, you can work through with clients to get something where you may be able to refinance it and be part of the refinancing. But the latter you get and the more critical liquidity becomes and the crisis becomes, the more likely it's going to be an exit either through refinancing or a sale of the entity.
Yeah, I mean, I echo both what Bill and Mike said when it comes to those topics off the top of their head. But I was trying to kind of recall over my career at a money center bank and just how many times we did return it, and I want to say we were pretty good. It's really depending on the business cycle where the bank is at a given point in time too. If it's 2010, there's probably not a whole lot of appetite to move a lot of stuff back to the line. They're still putting out fires. You still see a bunch of inflow coming in. It's more likely that a refinance is going to be more typical. But when times are good and there's a lot of competition out there for deals, they can be a lot more. Hey, don't kick this out the door because I'm gonna have to hire 2 more bankers from another bank to go win this new deal. So do what you can to save it if you can and give it back to me so I don't have to originate it. But sometimes it's really borrower specific too, because we'll treat them we always treat, I feel in my career, I've always treated every borrower professionally. I try not to take things personally. You try and understand that this is a business decision, and you do what you can, but sometimes they'll take it personally, and the first opportunity they are bankable, they'll go and refinance it. So we'll send it back to the line, and then 6 months later they're gonna pay it off, and that line kind of gets a little bit squirrely about that, and they're not happy, but it's just kind of a fact of life. I mean, the relationship kind of deteriorated once we had to make the move and there was a default, even though we were fair and we gave them the time and we restructured it, whatever. So it's really asset specific, but I don't think I can give you like a 70-30 split. I think if I had to handicap it, I don't know, 55-45, 50-50. It just, higher percentage of deals that came in retain go back retain than if it comes in as an exit. It very rarely do I find something that says, oh, let's change it to a retain and let's send it back. That process rarely happens.
So Jason, I'm gonna stick with you. I'm gonna change the topic a little bit. One thing I was actually surprised by the amount. Well, it seems to me like this is happening more and more, and that's banks selling the loans. Has there been an increase in that, and how exactly does that work?
Not if you ask a lot of distressed debt buyers, they're going to tell you no, there hasn't been a increase. I think it's more just because of where we are in the market, and I think there's a real big bid-ask spread, at least on commercial real estate. I'm not in the corporate world like Bill is to tell you, how actively those securities trade, but it is a tool that was probably underutilized in past recessions, or just wasn't as robust as it is now. So the pricing, coming out of the Great Recession, I had I had distressed debt buyers telling me they had an unleveraged yield return of 17%. And that's like basically equivalent to a 65 cent on the dollar sale price, 60 cents on the dollar sale price. And at that point, on NPV, I could probably do a better job of getting to the asset, even with the larger backlog in cases and stuff, or structuring a stipulated foreclosure or whatever to get to the asset and have our ORE people liquidate it better at a better return than 60. But recently, I mean, there's a lot of money that are out chasing those deals, and there's not a lot of banks that are selling for whatever reason. Either they have, optics and financial pressures that are preventing them from doing that, or everyone's crossing their fingers for rate cuts to happen in the future. So they're hoping that values come back magically, if we get some rate cuts. But it is a much more utilized tool than maybe it was in the past, especially for the instruments that aren't as actively traded for smaller real estate loans and stuff.
And what does a bank consider when determining whether or not they should sell a loan versus restructuring it, or continuing the relationship?
Well, that goes back to what we've been talking about all this whole afternoon, which is basically, what's the strategy that the bank has on the front end? Is this a retained customer? Do we have do we have a full relationship? Do we have all the pocket, the pocket share here? If not, that'll kind of winnow down your decision. Do we believe in the management? Is the capital, can they get capital to plug in some of the holes that we see in the balance sheet or whatever that's going to be? Can they do this turnaround? And if the answer to those things are kind of no, or it's the bank is making the decision that we're exiting for geography reasons, industry reasons, whatever. If it's an exit, then the bank needs to figure out, all right, how quickly can Jason work this deal out to a refi, or at what discount does he have to give the customer to do a refi, if any? Or does it make sense if foreclosure is the only available option? Does it make sense on a net present value basis, based on what I believe the collateral is worth, to sell it to an investor that will do the heavy lifting and the restructuring and collections? It's all about, going back to what Bill says, what's the best resolution? You have to know the documents inside and out. You have to know your credit file inside and out. You know your customer inside and out, so you can project that all out. Here's my inflows, or all my debt service payments, or whenever I can liquidate, discounted back at the loan loss reserve or my internal rate of return, or whatever the bank's standard is, versus all the costs that I'm going to have to pay you, Jim, for you to litigate and for me to service it and everything else that goes in it, all the reports I have to get and appraisals and environmentals.
I think the best way to summarize it is to kind of, I think I mentioned this earlier, is what's the best risk-adjusted net present value return to the bank based on the desired outcome. I think that encompasses everything of what we try to do. And that will dictate the strategy, whether it's sale, restructure, et cetera. But it all comes down to the risk-adjusted. And again, risk-adjusted is execution strategy.
It's really, yeah. I mean, so if it's a year that I'm going to give a year extension to a borrower to effectuate a refi in this market with credit conditions being tight, am I being a little bit too generous with the balloon that's going to come in month 12? Probably. Maybe I should kick that out. We'll probably have to do another extension. Now you're 2 years out. And I could sell it tomorrow in 2 months, right? And
Right.
I'm going to get a known number in 2 months versus an unknown number in 2 years. It's kind of the certainty you have there, and just a function of the time value of money. But that's really kind of how the high level math works, or it should work when you're making those decisions. But there will be other mitigating factors like reputational risk, exclusionary assets, deals that you can't sell for whatever reason, in which case then you have to take that option off the table, and now you're figuring out different strategies.
Mike, we had the opportunity to discuss the Netflix movie A Man in Full, Thomas Wolfe's novel. And for those who haven't, well, for anybody on this that hasn't seen it, you know, there are some very interesting episodes with respect to negotiations and how bankers approach things. I think earlier you said you've been doing this for about 4 decades. So what are some of the things that what are tactics you use in negotiations or approach negotiations with a borrower?
Well, you're right about that movie, and I guess I could answer the question sort of facetiously by saying, watch the movie or the miniseries or read the book, and whatever Harry does in that, do not do that. My philosophy has been that, I mean, there are very humorous situations, but it's not really reality. That's not to say that there are not people that believe that the way to be the most successful workout person is to, you know, pound the table the hardest and scream the loudest. But I couldn't disagree more. So I've generally taken the approach that, you know, it is sitting here, and we talked about the needs and the wants earlier, and it's, you know, it's dealing with the company. It's also from the standpoint a lot of times is that because there's a lot of apprehension when they get transferred to a workout group. I mean, I would generally try to add a little bit of levity on the front end. The guy is going to sit there and he's going to tell me that, you know, he is happy to meet me or something like that. And I just turn around and say, you've lost all credibility because I know you're not happy to meet me at this particular point in time. And I often say also to them that the situation was that, and which side of the aisle I'm on, whether it's as a consultant now or not, is that people really, both the borrower and well as the lender, really don't have that dissimilar of an objective. Now, people initially will throw up all over that issue and say nothing could be further from the truth. But both of them are in a situation where neither of them want to be. They want to create and move to some other opportunity or situation. And, you know, typically when a company comes in, this is an overgeneralization, but, you know, borrower is going to come in and he wants more time, more money, and be left alone. And lenders, on the other hand, want their money yesterday. Well, that's an obvious train wreck. And the truth of the matter is neither of those parties really want a train wreck. What they want to do is find a way to meet somewhere on this continuum that you can get a deal done that both can live with. You know, and where that ends up sometimes is a function of who's a better negotiator. It's a function of who might have more leverage, who needs the one more than the other, or sometimes the fear factor comes in. It's the fear of what it could ultimately look like in that situation. So, you know, I just sort of walk through all of that and basically say that, look, I'd rather do this the easy way rather than the hard way. And that's on a collective basis for us to get from A to B, or for both of us to get to some particular spot that we both can live with. You know, it's the old example, or I guess saying about, you know, you've got a good negotiation when neither party is really necessarily, you know, ecstatic about it. It's something that you can live with. So those are sort of the things just off the top of my head that come out.
Yeah, what I would add to that, Mike, and I have the exact same philosophy, is that most of the time when you think you got the better of a deal, you could be a better negotiator, but most of the time when you really think you hit one out of the park, either A, it's not going to close, or you missed something big. Because the truly successful workouts is when everybody leaves the table disappointed, but there's not a better solution for either. And that's the biggest thing, is helping people to get to realistic expectations. And that's both sides of the table.
Mm-hmm.
Yeah, I think that, you know, the numbers are obviously important in these situations, but the biggest challenge that I see to finding that common ground that I mentioned earlier are personalities, egos, and a general misunderstanding of the role that human dynamics plays in these situations. And so, you know, again, it's not like the Harry Zale character in A Man in Full. It's more of a function of who's a better listener, the one who takes the time to understand the landscape and the objectives of the various stakeholders who are in the deal. It's back to that needs and the want things. Who's the better communicator that can actually educate people to the differences? It's all of those sort of things. And by being a good communicator in a lot of these situations, and if you take the time to explain why you said no or why you won't do something, it's not that necessarily the party on the other side is going to find it any more agreeable, but at least what it does, it indicates to them that there is an underlying business reason as to why you're doing what you're doing. And it's not just I'm doing it just for the sake of spite. So it takes the emotions out of it. And the other thing that I found that when you do that is that it actually, when people are hearing what the explanation is, light bulb may go off and it says, okay, I understand, but if that's what your objective is, there's another way to skin the cat. And maybe we can do this instead. And so you come up with alternatives or potential solutions that otherwise might not have ever surfaced if it weren't for people actually communicating with each other.
Yeah, I mean, I can't agree more with what Mike and Bill just said. I mean, I always found it frustrating when my bankers would come back to me and say, he was so mad at me because, I did what you told me to, to deliver to him, or I gave him this deal and he just blew up on me. I don't understand. I was like, well, did you explain how we discussed it? Did we walk through the steps on, this is why this is a red line. This is why, what we're seeing in this trend. Did they have an answer to this? Like, what was their response? And we'll work. I mean, a lot of it's horse trading and other things that you can do, but that's kind of like, kind of ancillary when it comes to putting yourself in their situation, understanding, at least in middle market business banking world, it's more or less a emotional decision because it's their business. This isn't a publicly traded company, and this is something that they've built from, usually, or their family built, and this is how it's impacting, or this is their sole asset, this is their retirement fund. Like this is what they were banking on. And so that's kind of where, to help with that negotiation, and I always found it useful to kind of run a net present value analysis on a workout restructure and what it would look like on a foreclosure one, or a discounted payoff, or stipulated foreclosure, or whatever, and get two kind of, deals that were the same NPV more or less, and give the borrower two options. Let them make the choice, and then I will know kind of what decision they make, how much they believe in their own expectations. If they take the discounted payoff, it means they don't believe in their business. So, or they're just trying to get out of it, or taking advantage of the opportunity. But if they go for the restructure with a lot of reporting, and that's going to take a lot of time, they're probably going to fight you down the road. And just know that, you need to, this is very personal to them. And I always found that was kind of helpful.
I think at the end of the day, what Mike said is the 100% most important thing. It's take the emotion out of it. It's not personal. And once you turn down and keep the temperature lower, people tend to make intelligent decisions. But once you, as I call it, you cannot explode a bomb. Once you've ratcheted up everything to the point of litigation and threats back and forth, and you did this and you did that, you've now lost focus on what the objective is, which is to get to a resolution both parties can live with.
Yeah, and I would, when it comes to the emotionality of it, it is really easy to match the emotions of the person across the table. So in a business banking workout where it's a very, it's personal to that person, they could start yelling and call you every name in the book. And, what I would always coach people is, and I wasn't perfect on it either. Sometimes you just react. But that comes with effort and time and experience. Take what they're, take their emotions. All right, this is not a good time for us to continue this discussion. We're going to continue this at another time. We may have to, include our attorneys going forward, or whatever that's going to be, and just try and lower it back. So again, we can all make rational decisions. But yeah, if you're just going to get into a yelling match, it's never going to be the best solution for anybody.
Okay, well, with that, we are at the 1 o'clock. We're at 1 o'clock. Haven't received any further questions. If anybody wants to get in a quick one in the next minute or so, I'll read it off. But gentlemen, I thank you for taking the time to go through this. It was,
Jim, one last thing I
Sure.
wanted to add. One of the things you wanted to talk about litigation, and just briefly, when do things lead to litigation and bankruptcy filings? When negotiation on a consensual resolution is not possible. Nobody wants to be there. The banks don't want to be there. The borrower doesn't want to be there. It's an elongated process that damages the company, the bank's collateral. And it's really when the sides aren't able to go through the process we just described over the last hour to get to a consensual resolution.
Well, Jim
Yeah,
likes it,
yeah, I was going to say, as the lawyer
likes
on
it.
this,
Yeah, you're part of the process. We're
You're-
just keeping the bills down.
you hurt me, Bill.
Yeah, we're just keeping the bills down.
Well, I got one more comment. It says, thank you all for the webinar. So on that, thank you all for the webinar. I appreciate it. I really enjoyed, this is actually the first time I got to meet, Bill and Mike. I knew Jason from the old days. But I really appreciate it, and hope to see you soon.
Thank you.
Thank you, everybody. Have a great afternoon.